What's up, everyone? Welcome back to Entrepreneurial Edge. Today we're diving deep into the world of investing, exploring 11 common mistakes people make when the market seems like it's on fire. We're talking about those times when everyone's feeling overly confident, throwing money at anything and everything. We've all been there, right? But don't worry, we're not just going to point out the pitfalls, we're going to learn from the best. Throughout this video, we'll be drawing invaluable lessons from the Oracle of Omaha himself, Warren Buffett. Let's rewind the clock and take a trip back to Warren Buffett's early days. He didn't start out with dreams of Wall Street domination. Initially, he set his sights on a career in law, but he stumbled upon investment management, and that changed everything. He scraped together $15,100 to launch his first partnership. Buffett's philosophy was heavily influenced by Benjamin Graham, the father of value investing. Let's dive into Buffett's strategy, value investing. It's not about chasing hot stock tips or timing the market, it's about finding undervalued companies with solid fundamentals. Buffett's acquisition of Berkshire Hathaway is iconic. It was a struggling textile company, not glamorous, but Buffett saw its underlying value and potential. He acquired it at a bargain price, and the rest is history. Now, even the Oracle of Omaha has made his fair share of mistakes. Remember how I mentioned Berkshire Hathaway was originally a textile company? Well, Buffett himself has admitted that buying it was actually a mistake. He got caught up in the idea of turning around a struggling business, thinking he could apply his investment acumen to an industry he didn't fully understand. But the textile industry was changing, and Berkshire Hathaway's struggles continued. From that point forward, he focused on investing in companies within his circle of competence, businesses he understood inside and out. Now let's talk about market cycles. The market is like a roller coaster with its ups and downs, its periods of euphoria, and moments of sheer panic. Understanding these cycles is crucial for any investor, especially during times of overvaluation. Think back to the dot-com bubble of the late 1990s and early 2000s. Everyone and their grandmother was piling into internet stocks, convinced they were sitting on the next Microsoft or Amazon. Valuations soared to astronomical levels, driven by hype and speculation rather than sound fundamentals. And we all know how that story ended, right? The bubble burst, wiping out trillions of dollars in wealth and leaving countless investors in financial ruin. But amidst the chaos and uncertainty, Warren Buffett remained a beacon of discipline and rationality. While others panic and sell at the first sign of trouble, Buffett sees opportunity in times of fear and uncertainty. One legendary example is his investment in the Washington Post in the early 70s. The market reacted with fear, sending the newspaper's stock plummeting. But Buffett saw something different. He acquired a significant stake for a mere $100 million. Today, that investment is worth billions. In a world obsessed with short-term gains, Warren Buffett advocates for long-term thinking. He focuses on exceptional companies with durable advantages, businesses built to stand the test of time. Once he finds these gems, he holds on to them for years, allowing the magic of compounding to work. Remember his investment in Coca-Cola? He's still holding those shares today. Now let's talk about a silent wealth killer that keeps Warren Buffett up at night: inflation. You see, inflation is like a slow leak in your tire. It might not seem like much at first, but over time it can gradually erode the purchasing power of your hard-earned money. And in today's economic climate, with governments around the world printing money like it's going out of style, inflation is a very real threat. Buffett has warned about the dangers of inflation countless times, cautioning investors that holding on to large amounts of cash can be a losing proposition in an inflationary environment. He advises investors to seek out businesses that have the ability to pass on rising costs to their customers, companies with pricing power. As Warren Buffett's career progressed, he realized that investing wasn't just about analyzing numbers and crunching data, it was about people. He surrounded himself with a team of trusted advisors and managers, individuals he could rely on to make sound decisions and uphold the values of Berkshire Hathaway. Buffett understands that no one, not even the Oracle of Omaha himself, is infallible. Having a strong team in place provides a valuable sounding board, a group of diverse perspectives to challenge assumptions and mitigate the risk of blind spots. He meticulously crafted a succession plan, identifying individuals with the integrity, intellect, and temperament to lead the company he had built into a global powerhouse. Let's be honest, who doesn't love a good market prediction? We're constantly bombarded with forecasts from economists, analysts, and self-proclaimed gurus, each claiming to have deciphered the secret code of the market. But here's the cold, hard truth. Predicting the market with any degree of consistent accuracy is about as reliable as forecasting the weather 6 months in advance. Yet, investors continue to fall prey to the allure of market timing, convinced that they can outsmart the collective wisdom of millions of other market participants. This overconfidence often leads to ill-timed trades, missed opportunities, and ultimately, disappointing returns. Warren Buffett has consistently cautioned against the futility of market timing. Instead of trying to time the market, he advocates for a disciplined long-term approach. Now, let's talk about a fundamental principle of investing that's often overlooked, especially during bull markets' diversification. You see, when the market's on fire and everything seems to be going up, it's tempting to throw all your eggs in one basket, to chase the highest returns, regardless of the risk. But as Warren Buffett famously said, diversification is protection against ignorance. It makes little sense if you know what you are doing. Now I know what you're thinking. But Graham, Buffett himself has made concentrated bets throughout his career. He's not exactly the poster child for diversification. But there's a crucial difference. Buffett's concentrated bets are the result of his deep understanding of specific businesses and industries. In the world of investing, there's an undeniable allure to the promise of high returns. We're constantly bombarded with advertisements and investment pitches promising to double, triple, or even 10 times our money in record time. It's enough to make even the most disciplined investor question their strategy. But here's the thing, high returns often come with high risks. If an investment sounds too good to be true, it probably is. Warren Buffett's investment philosophy is the antithesis of chasing high returns. He's not interested in get-rich-quick schemes or speculative investments that promise the moon but deliver a crash landing back to Earth. Instead, he focuses on the steady, consistent growth of undervalued companies with strong fundamentals. So, there you have it, folks. We've explored 11 common mistakes investors make during overvalued markets, and we've learned invaluable lessons from one of the greatest investors of all time, Warren Buffett. Remember, investing isn't about getting rich quick. It's about building wealth gradually, patiently, and strategically. It's about understanding market cycles, embracing long-term thinking, and resisting the temptation to chase high returns. As we navigate the ever-changing landscape of the financial markets, let's carry these lessons with us.